Welcome, everyone, to the Planet MicroCap Showcase Virtual 2022. I'm your host, Robert Kraft. And now presenting is Rob Chase. He's the executive chairman at MediaValet. It's a publicly traded company. The symbol is MVP on the TSX. Rob, take it away.
Thank you, Robert. It's great to be back and looking forward to the show. So before we get into things quickly, the safe harbor statement applies as per usual with regard to any forward-looking commentary, etc. So just quick recap on MediaValet. I know we've done this conference before, so hopefully familiar to some of you, but again, emerging leader in enterprise class digital asset management. We're there to manage and secure and help share all the content that organizations must rely on today if they're going to be having a successful digital strategy. So great tailwinds in the market for enterprise class digital asset management, and I'll cover that in a second. We've got a 40% 5-year CAGR, $13.65 million in ARR, and very sticky customer base, over 100% net retention. And really happy with what we've been able to do in the DAM market as a standalone platform here. Differentiated technology that we've been building out for the last 10 years, investing over 40 million in the business over that time frame to build what we have today, and looking forward to continuing to advance the technology and win a greater share of the market. Ended our third quarter, September 2022, with almost $3 million in working capital and another $7 million available to us on an LOC should we need to use it to fund our growth. And indeed, we have been investing to grow right through COVID, right through all of the economic turmoil that we've all seen. We continue to see great pipeline and interest in MediaValet as a result of the digital asset management industry. As people must digitize their organizations to be successful today. So, we've been leaning in, and we doubled our headcount, pretty close to it in 2021, and we're just maintaining there now. So maintaining that investment and growing into it, but it's given us the scale to be able to take on much bigger opportunities as a business and to go and grab a bigger share of that market. So the market itself has been undergoing a fantastic growth trend over the past few years, and looks like it'll continue. In fact, 2021, when at the beginning of 2020, when people were estimating, industry analysts were estimating where the market would go, they figured it'd be about a 13% percent growth in 2021. It surprised them at growing 24%. Again, we've just gone more and more digital, right? Look what we're doing here today. So it's all digital. And as a result, their outlook for the future has gone up as well. Their 5-year outlook last year was to $7.5 billion by 2026. Fast forward a year later, they're looking at $13.4 billion by 2027. So obviously, analysts are seeing the need for DAM continue to accelerate. A big part of that is not just because you need to adopt the digital strategy, but also it saves you money and helps you market better. So, you get a double whammy, both great ROI from a cost perspective, but also increased revenue growth as a result. Again, MediaValet, why us? We are seen as enterprise class DAM, but we're trying to deliver an enterprise grade DAM solution that's easy enough for companies of all organizations to use. And in fact, what you'll see is, our smallest customer pays us about $6,000 US a year. Our largest customer pays us over $600,000 US a year. I mean, there really is a customer size. There's not a customer size we can't support, and across the globe. So, great infrastructure built on Microsoft Azure platform as a service, which gives us ability to service these organizations globally. We are optimized for high volume, high value assets. And, we're infinitely scalable, hyper scalable and elastic. So, true SaaS, and are able to grow with our customers instantly without having to spin up different VMs or what have you. It's all seamless. We're really known for our support in the industry. If you looked at the G2 reports, they're available on our website if you want to go get them. But, really, we stand out on our support. And a lot of times that's why organizations will choose us to be their DAM vendor of record. And we've also continued to innovate and stay innovative in DAM. We've done some unique things in the industry. I've been first to the market with a number of innovative solutions for DAM. And I think it just stems from us being really good at listening to our customers and trying to help them solve their problems and also help lead us to the best way to win in DAM long term. So it's been a good strategy for us and has kept us differentiated in the market. From a technology perspective, we're investing on building a DAM that can be truly cross-foundational for an organization and enable us to support not just marketing and the go-to-market team, but the entire organization itself with their content needs. And so we're building that out, a DAM that can be truly converged, fully aware, and able to if you're contextually aware, so that you're typing an email to somebody, and it will be interpreting what it is you're typing and serving up digital assets that make sense for you to use in that context. So I could be saying, hey, Robert, here's our Q3 results. And as I'm typing away, it's coming up on the right side of the screen with, my Q3 MD&A, my Q3 press release and investor deck, etc. So pretty cool stuff. That's where we'll get to eventually. A lot of foundational layers go into providing something of that magnitude. And, while that's where we're headed long term, day to day, we're figuring out what customers really need to make a difference today so that we can continue to increase our win rate and continue that nice 40% CAGR that we've achieved in ARR growth. Turning to the customer base, over 465 customers now. You can see a reasonable split across the globe, but obviously North American focused. We can support organizations anywhere, as I mentioned, across the world. Again, you can see the customer size here, great range of customers, really proving out our ability to make DAM easy to use. It really is a requirement across all verticals. Every industry has to go and digitize. And so that's continuing to drive that need across all sizes and types of organizations. And again, the customer retention is extremely high. 100% net retention. Currently, our gross churn rates are half of industry average. And as our team continues to mature, I think we'll see our expansion rates start to get a lot higher as well and give us a shot at that 105 to 110% net retention levels that we're accustomed to for successful SaaS companies in the long run. So we're building towards that now. Just a quick couple of examples for you, some customers that we've won recently. This is a global leader in industrial software. It's a $65,000 a year annual contract. They would have signed up for a 1-year term when they came on with us. They took our audio visual intelligence module, which is one of the unique advantages that we have in video. We really stand out. You'll see a lot of our customers taking this capability. Various other add-ons that really make the system more sticky within the customer's environment, just tie it into their environment that much more and become seamless part of their day-to-day. We'll just, since we have extremely high net retention rates, we like to sign 1-year terms. That's pretty much what we focus on. We bill at the start of the contract and then just recognize the revenue ratably over the term. The same thing again here. Again, now we're in a completely different type of industry, right? With the sports camp organization, global organization. Again, $43,000 a year contract. They actually did prepay for a 2-year term. We don't usually push for that, but if customers want to do that, again, it's part of who we are. We like to try and help the customer achieve their goals. And if they want a 2-year term, we're happy to consider it. But we're not going to push for it. Again, because our churn rates are so low. It makes sense for us to stick with the plain vanilla, go for a 1-year. Again, it's got the audio visual intelligence along with some other integrations that we have to tie it into their organization that much more. And again, here's a large chemical conglomerate. Everyone here would know their name. And, they've grown with us, every year or two, they add another division. And, they started at, I think, $12,500 a year with us about 7 years ago. And now it's $116,000 a year. And there's still more to go. So that's the kind of evolution we like to see in our customers and really speaks to, the support we're providing, the value we're providing, and love to see this kind of thing with expansion like that. So turning to our financial performance, been a great year for us. Revenue up 36% for the year to date, 39% in the quarter. And as you can see, a majority of the revenue is recurring. We do have some upfront fees that we charge for implementations on new customers. but it's generally small. So if we sign a, say, $100,000 contract, about 15,000 of that is usually the upfront piece to get them up and running, and then the 85 would be the ARR portion. So you see a bit of upfront here being the difference between the 96% current recurring and 100% of revenue there. Gross margins remain strong. We expect to continue to see that over time, pretty consistent with SaaS companies. As you can see in the total operating costs, including cost of revenue, which is obviously up on revenue growth. We've obviously been investing heavily in our sales and marketing and R&D, particularly R&D. I mentioned earlier that we're building out that maturity model and want to accelerate that as fast as we can to help us go and grab as much of the logos that are coming to the table today as possible, looking for a DAM. So we think that's very important, gives us scale, gives us more opportunity, and but we are holding the line. So if you look at that increase was finished about Q4 last year. So really, while it says our total OpEx is up 33% over last year, it's really up only 2%, which relative to our Q4 2022 run rate. And most of that is really just our cost of sales increasing. So we've really held the operational foundation stable since 2021. We're going to continue to do that while we grow into our OpEx so we can get to cash positive. When you're thinking about cash positive, it's always important to look at the billings-based operational cash flow, as you see on the slide here. And that being the case because, again, we bill our customers up front annually, what we ratably recognize the revenue over time. So the billing is the cash in the door. That's the piece that if we compare to our cash expenses, will tell you whether we're getting closer or not to cash positive. This year, it's obviously the burn went up in 2022 simply because we have a full year of that ramped team that we completed in 2021. So again, we've held the base stable, but last year we were adding those people through the year. So the OpEx was climbing quarter by quarter, and now it's stabilized. So we'll see that burn go the other way. And incidentally, Q3, great net billings, quarter four is 3.8 million. Year to date, 9.8, up 43%. Q4 is our strongest billing quarter of them all. That's just where our billing cycle lands traditionally. And usually it's 25+% up over Q3. So you can expect our net billings for Q4 to be at least 25% higher than what we have here in Q2. So we'll hit our strongest quarter and again take a bite out of that cash burn number there on a quarter basis. We also have access to a $7 million LOC. It's with TD Bank, and it's based off our ARR, so that they've been a great partner. So we have that to help us get through to cash positive if needed, and happy to use that strategy. It's we think by Q4 2023 we could be at cash positive level. It's the plan, and that would be probably what we want to cover. As you can see, ARR up 36% to 13.65 million, and getting a little bump these days now from the US dollar in reverse of last year, which was a headwind year for US dollars. But so it's good to see that turning at the US dollar improving in strength. And just to graphically represent here, important for us to watch is that we've now crossed the lines down here between the blue and the red. You see there, OpEx now is growing slower than revenue, and you'll see that spread continue to grow here as we go forward and hold the line steady on OpEx. So it's good to see the lines crossed, and now we'll start widening them. Just to know we watch that closely. Looking at the market capitalization as of yesterday, we closed at $1.18. You can see the range has been $1.04 to $2.22. And we just got here for you the enterprise value multiples that results in, 3.4 on trailing ARR, on analyst consensus 2.2 times what we're trading at the moment, and the analyst consensus is down there at the bottom, as you can see, $1.75 to $2.50 price target at the moment. But really happy with our growth and think that the analysts have done a pretty good job of capturing where we are. But if anyone is able to get access to those, and ownership, 39% owned by insiders, officers, directors, employees. and another 35% that we're able to identify with institutional wealth and family office ownership. So gives you a little idea of the structure. And with that, I'll open it up to any questions, Robert.
Absolutely. All right. So my first question I want to ask you on here, and again, this is something that I'm asking to all the companies that are presenting here. So the first question is, we're managing through tough markets right now. What measures is the company taking to manage some of these macroeconomic pressures that are currently affecting most microcap companies across the board?
It's a great question. And, a lot of those headwinds are more in capital markets than they are in our actual markets. And that's not uncommon. We've seen those disconnects many times before. So the first thing, first of all, I would say, again, going back to, where we're spending and things, I mean, there's a lot of discretion in here. So if we do ever need to, we are able to cut back without hurting our current growth prospects. A lot of that R&D investment, we're talking multi-year investment, right? We'll see a year to 2 year type of returns on a lot of that. So it is, we're investing for the future. We don't necessarily need to invest as far out though, right? So if we see the market softening a little bit from the macroeconomic side of things, then we're able to move quickly. 60% of our cost is payroll, and in fact, 2 million of our R&D spend is consultants. So we are able to move quick if we need to. But and so for us, we have about a 90-day sales cycle, which is pretty advantageous for us because we get a pretty good look out 90 days and can quickly react to it if we see the market drying up. So we are watching for that closely, but we continue to be encouraged because we see the DAM market having tailwinds that could potentially offset, right? And so as long as we see those tailwinds continuing to drive enough pipe for our salespeople to get to our numbers, we just need to keep on marching. And so we're hoping that we'll be able to continue that strategy and hold the line while our foundation really solidifies after doubling the headcount in 2021, right? I mean, the old storming, forming, norming type of discussion about a team, building a team, I mean, is absolutely true. And so in 2022, this is the forming year. And we want to get that that team time to gel and really produce. So the long if we're able to just continue as we are, and we do have the capital to do it, so that gives us more chance for the future. And that's where we are now. But if we had to, we can react. We just at present we haven't seen a need to as yet.
Absolutely. So another question I have for you is on the company's marketing strategy. You're in one of those businesses where you could kind of, you can make a case to any business that they need what you're selling, being a part of the DAM market, DAM. So is the company's strategy to focus on any particular verticals specifically, or are you kind of painting with a broad stroke and going after multiple different ones at the same time?
Yeah, I mean, it's a great question, and we often sort of think about maybe double clicking on some of the industries, right? Some verticals, like we've had some really good success with some sports teams lately, right? So we've got 3 NBA teams, two NHL teams, and there's some really interesting things we can help those folks do that may make that a vertical worth double clicking on. But for the most part, what we're looking for is people that have a digital strategy, have a high volume, high value, and high velocity need for those assets. So in other words, they're trying to create lots of content that is dynamic and fresh, and they're trying to get it out quickly to the right places at high volume. And so whether that be your social media feeds, your website, or your people, like whatever it is. And so having a DAM is very important, and we're looking for those types of opportunities on all sizes of organizations. It's predominantly a marketing equation and a marketing team that we're marketing to, but that problem is everywhere today. Like, people are drowning in content, and so that's everywhere around the world in every industry. The real common thread: marketing team with this type of use case. If they're just looking for a photo library, they can go to one of the cheaper DAM vendors. we're going to enable them to have the flexibility of an enterprise DAM, but nice and easy to use. So that's why we can hit all sizes of organizations.
Absolutely. Another thing I wanted to hit on, in terms of headwinds, we talked about a little bit when I asked you that first question, but sometimes you hear, in recessionary markets or inflation, that this is where most firms tend to start limiting on marketing spend. That tends to be what gets hit first, right? So how has that potential headwind affected MediaValet? And if it has, how are you approaching it?
Yeah, great question. And as I mentioned a little bit earlier, we really haven't seen a slowdown in interest and activity in the DAM market. And in fact, what we saw was, I hate to get an eye chart up here for you, but I can do that just for fun. But what we saw is we've been really leaning into customers of all sizes, trying to make sure that we're balancing our go-to-market so that we don't have any real reliance on one particular customer size or segment. We love the large deals. We love enterprise deals. And so on this top right here, you can see some of these, the darker blue one and the purples, those were the record quarters, but you can see the impact of large deals, right? And we had some great large deal performance in Q1, and those can be real movers for us. But what we're trying to do is make sure that we can get most of the way to our number just off what I call singles and doubles. So the smaller opportunities, which tend to be a little easier and more capable of getting done in this climate. The larger organizations, it feels like some of them have kind of put a 2-year hold on major projects, right? And I think that that's going to expire soon because they just can't keep holding off when everybody's digitizing well and they're not following. So we think we'll see some larger ones coming back, but we're de-risking that by going to some of the smaller opportunities, right? Because they just have to digitize, right? And so if that's how we're trying to shield ourselves a little from that. But as I said, it's less than a 90-day cycle, especially on those ones. In fact, this year our deal cycle has come down toward 80 for the whole year, which is amazing. So what that means though is we're going to get a good look. We're going to get a good look in quarter, and if we say, hey, the market has changed and these things don't exist anymore, we're going to be able to act quickly. As opposed to if you had a year-long cycle that you're relying on for the large type deals, they could be stringing you along for ages and finally tell you 3 months from purchase date that we're not going to go ahead. And meanwhile, you've spent 9 months of OpEx thinking you're going to get these deals. So I think that this gives us a bit of a buffer. And it's not what we reacted to. It's not a reaction to what's happened. It was originally done just to make us, provide an element of stability where we weren't relying on the binary large deals to do something great.
So now looking ahead to 2023, from what you can tell us, what would you say are some of the company's value catalysts that you think folks should pay attention to? You mentioned in the presentation how you're looking to get to cash flow positive, the goals by Q4 next year. So along with that, what are some other things that folks should pay attention to?
It is a lot of it will be execution wise, like some of the deals we're landing. Everything we're doing is pretty incremental. There will be some product releases that could be meaningful that'll come out, but really just watching for some announcements about some of those deals coming along, good corporate governance type stuff coming along, and I think then just watching the results, it really comes down to execution as we get closer to that cash positive marker, and as people see that we do have the capital we need to cross that barrier, then because we believe we do, but of course it's harder for people to see on the outside, right? So as we get closer to that, I think that becomes a catalyst in and of itself.
Absolutely. All right, Rob, we're there. Thank you so much for your presentation here today. We really do appreciate it. And to everyone watching, thank you for participating and enjoy the rest of the event.
Thank you, Robert. Have a great day. Good luck with the conference.
Thank you.